Hi, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastore. As the continued rises in inflation and interest rates remain, we wonder, how is this impacting the housing market? We're going to discuss that right now with my guest, John Walshin, real estate and lodging analyst with the UBS Chief Investment Office. John, great to see you. Thanks for joining us in the studio. Housing market, I'm sure you're getting a lot of questions on it, so I'm glad you're here to answer some of it for us today.
My pleasure. Thanks for having me, Anthony.
John, so let's talk about the housing market right now. We're in a rising rate environment. Obviously, we're watching closely what the Fed's doing. There's so much volatility. Markets are a little bit wonky these days. How is that all impacting home buying as it stands today?
Yeah, so I think if one were to have dropped down from Mars and just looked at the data, they would have concluded the housing market is in terrible shape. And we're getting mixed messages. On one hand, we're seeing clearly slowing activity in terms of transactional, both in the new and existing home market. The rate of price appreciation is certainly starting to slow in a number of markets. But on the flip side, if you look at the national price appreciation numbers from their variety of home price indices, we're setting records there, number one. And number two, home prices are at all-time highs.
Yeah.
And a lot of that is driven by what is still a dearth of supply, which has been really a problem since the ending of the global financial crisis. Now, our view is that we will start to see more supply hit the market, and we are seeing that actually, as we've gone from a market when interest rates started going up, when you had the fear of missing out of the low rates. Now you have people saying, the fear of missing out of the top in the market. So we think we will start to see more activity and more homes come to the market.
Yeah, and it's fascinating to hear you talk about it from that side, because all I can really think about is, my gosh, rates right now, 30-year mortgages are above 5% again, or just around 5%. And you've got, we just had the CPI reading come in, and it came in significantly higher than it was last month at 9.1%. But people, I guess, are still, that whole FOMO thing you describe, it really is almost an emotional experience for probably a potential home buyer at that point.
Well, look, I think it's important to put mortgage rates in context. It's unarguable that affordability is significantly lower than it was, because not only have we seen a massive move in home prices over the last 18 months, but we've seen a tremendous move in interest rates just in the last 3 or 4 months. But if you put mortgage rates in context, and by the time you add points and everything, let's say the 30-year fixed conforming rate is in the mid to high fives. Those are rates that my parents had in 1962.
That's right.
So I think it's important to put it in context, but the realities are, for a home buyer today, they are only looking at 5 months ago, my monthly payment would have been $2,000. It's now $2,800.
That's right.
And for many buyers, that's make or break.
Yeah, when you're talking to your friends on the weekend and we're all having dinner and so-and-so says, oh, I got my 30-year rate at under 3% a year ago, and you're thinking about getting it at 5%, it's almost like that painful, I wish I would have done it sooner.
Yeah.
So yeah,
right.
We're all in that boat.
Yeah, right. And the other thing we're clearly seeing is a massive slowdown in refi activity,
right,
which I don't think should be surprising to anybody.
So here's the question, John, because I'm sure that a lot of folks out there are wondering, we had a financial crisis in 2008 and 2009, and we saw the housing market truly shift around 2007, right before the crisis began. How is what's happening now different than what happened back then?
Yes, with the caveat that I've learned over the course of my 38-year career, the most dangerous words in our business are, it's different this time.
Right.
But that said, every cycle has its differences. And if we look at, of the many things that led up to the housing bubble and the ultimate bursting of the housing bubble, many of those things are not in place today. The lending standards were extraordinarily poor in the period leading up to the bubble. We had an oversupply of homes. Basically, and I actually heard a home builder say this on a call, if you can fog a mirror, we will sell you a house.
There you go.
You had poor behavior by borrowers, by lenders, by politicians. So everything was primed for what was ultimately a pretty tough scenario. Mm-hmm. If we fast forward, I don't want to tell you there's no excesses in the system, but if we look where we are post the global financial crisis, underwriting standards have been, depending on which side of the aisle you're on, not political aisle, but borrowing versus lending, they're either extraordinarily tough or appropriate. But the days of the no doc, low doc, liar loans, stated income loans, or my favorite loan, the ninja loan, no income, no job, no asset. assets, those days are largely gone.
That's right.
We have a dearth of supply. Now, supply is picking up somewhat, but if a normalized market is about 6 months of supply, nationally we're sitting for the existing home market at a little over 2 months, maybe 2.5 months. And for some markets, you're still looking at 1 month, a half a month. So the supply is very, very tight. You're seeing much better behavior by borrowers. You're seeing much better behavior by lenders. We have not had up to now, and we certainly hope we don't, any massive policy mistakes from our friends in Washington. And I would also highlight two things. Number one, if you look at the amount of equity homeowners are sitting on today, that number is about $29 trillion. That is a lot of money. Now, can equity decline? The answer is of course it can if home prices decline. But that gives a very, very big cushion. And the last thing I would say is, you know, one of the very unfortunate results of the global financial crisis was a massive foreclosure crisis. And so during COVID, there was this great concern that we would see a massive wave of foreclosures. And I think of the many good things, both at the monetary and fiscal level that we did, was to put a moratorium, not a moratorium, but a forbearance program in place. Now, forbearance is not forgiveness, but what it does is it gives breathing room to borrowers. So the concern was what happens when that forbearance program ends. So let's use real simple numbers. Your monthly payment's $1,000 and you miss 12 months of payments. So the concern was most Americans can't write a $12,000 check.
That's right.
Well, the way the program was structured, of the many ways to cure forbearance, one of them is to take that $12,000 and put it at the end of your loan as what's called a non-interest bearing silent second. In English, that means you don't pay interest on it and you don't owe that money until you either sell the home, refinance the mortgage, or your mortgage comes due. So while
to avoid more foreclosures,
yes,
due to the COVID pandemic situation.
And so I want to be clear: are there going to be more foreclosures? Sadly, the answer is yes.
Right.
But nowhere on the scale of what we saw. And the last thing I would say is one of the things that came out of the global financial crisis was the institutionalization of the single-family for rent business. Now, I know that there are some political consternations about that, and that's for a different discussion. But that is a ready pool of buyers out there to buy homes that are in distress. And so net, we think there are just many differences. But is the market going to slow in our view? And what we mean by slowing in terms of rate of a number of homes sold and price appreciation, the answer is absolutely yes.
What about on the home renovation side? Are you seeing people taking advantage right now before rates go higher? Almost the same scenario that you painted the picture of with house buying. What's the renovation market look like? I'm about to start mine in a couple of weeks, but I think a lot of people would be wondering, is this a good time to maybe do that?
Yeah, and so that was really, a huge part of the experience during COVID. People were sitting home and they said, well, I'm going to be in my house. I'm going to do a lot of renovation. So I think a lot of it depends on what the time period you're looking at is. If you're looking at the numbers year-on-year basis, it would indicate, oh, activity is slowing. Mm-hmm. If you look at it on a 2 or 3 year stack basis, it's actually showing some pretty good movement. Now, the other thing is, if you look at credit card data, it will actually show that activity is slowing. But the Harvard Joint Center for Housing Studies, they have an index, and it's called the Harvard Leading Indicator of Remodeling Activity, which not only brings in individual spending, but pro spending as well. That actually shows an uptick. So I think if we sort of net it all out, we're still going to see some pretty good activity. I think it's helped that lumber prices have come in significantly. Mm-hmm. With the slowing economy, I think there's more availability of labor. So I think we'll continue to see some pretty decent remodeling activity, but I think we also have to be cognizant of the fact that with elevated gasoline and food prices, among other, that's going to have an impact on the remodeling activity.
Yeah, absolutely. And, prices are going to go up over, I don't know what the time period is, but they're higher than they were if you say got a quote from a contractor 6 to 8 months ago or so, based on everything you're talking about. And the last thing I'll ask you today, John, is just within the investment landscape when we're looking at REITs, real estate, what are you recommending right now to investors who want to get in here? Are there any areas or within the sector that you find that there's some opportunities here?
Yeah, and I think it's really important for everybody to internalize a couple of things. Number one, real estate is a long duration asset. So even though you can buy real estate in the stock market via REITs, you're buying a stock first and real estate second. And so for anybody who wants to buy a REIT, that's a different conversation. We can have that offline. But in terms of investing in real estate, I do believe that there is opportunity to invest in real estate. We have to be cognizant of a few things. Number one, as I said, very, very long duration assets. So you have to have the time frame. Number two, it's an illiquid asset class. So any investments that you make, you have to be cognizant of your liquidity needs. Now, the good thing about real estate, or particularly private real estate, has very low correlation to the stock market, so it's a good diversifier in terms of thinking about diversification of risk. But in fact, we published a report on this last night. The fact that interest rates are up significantly, i.e. the cost of capital is up, but capitalization rates, and that capitalization rate, is the best way to think about it, is the inverse of a PE ratio. So the lower the cap rate, the higher the value. Cap rates have been much stickier because of the plethora of capital out there. So we're in an environment called negative leverage. Now, that doesn't mean you can't make money, but I think you have to be very careful how you underwrite it. And we go through some examples in the report. So we still are very, very favorably disposed to the residential rental market. That would be multifamily, single family, and manufactured homes. We do like the self-storage market. We like the industrial market. We like the shopping center market, particularly grocery anchored. Now, some of those lend themselves more to institutional investments. But what I would say is, a very, very sharp pencil is required in this environment because, like I said, valuations remain elevated, number one, and cost of capital has gone up. So we do see opportunities, but the great thing about real estate is every deal stands on its own. So you can pick your asset, you can pick your geography, you can pick your submarket, and you can also pick your underwriting assumptions. So, as we like to say, there are three things that have never gone out of style in my career, and I don't think they ever will. And that's free cash flow, that's risk-adjusted return, and that's appropriate underwriting assumptions. So we do like investing in real estate, particularly for those investors who can handle the illiquidity and have a longer time horizon. But this is a time for definitely more caution. The easy money over the last 10, 11 years has been made. So we say, yes, you can, but a little more caution is a good thing.
Yeah, be cautious about it.
Absolutely.
And thoughtful. Great, John, thank you so much. Always a pleasure. We got to get you back, though, because I barely got to talk about the rental market with you, which is a whole other story in and of itself, and especially the commercial market, too. Lots to talk about on that side as well. We'll get you back.
Thanks, Anthony. Happy to do it.
Yeah,
and great to talk to you.
You too, John Walsh. Thanks very much. And for more information on anything John talked about today, plus other commentary from our Chief Investment Office, visit our website, ubs.com/views. And make sure to follow us on social media, LinkedIn, Facebook, Instagram, and Twitter. We've got content up there. Plus, check out all of our past UBS Trending episodes on demand. And if you have any questions about how this conversation could potentially impact your own portfolio, make sure to speak with your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone, and remember to keep your eyes on what's trending. We'll see you soon.